What's up, you guys? Welcome back to the Average Joe Investor channel. My name is Joe. On this channel, we talk exclusively on how to help the average Joe go from being just, average financially to becoming financially independent. This video is not clickbait by any means, and it is not a typo. Would you like to learn how to get 40 to 50% annualized yields in your cash flow portfolio? I'm going to show you in this video. Specifically, we are going to go into detail what this income strategy is, how it works, what types of returns you can actually expect, and I think most importantly, what are the risks? Because every single investment, scratch that, every single action we take in our lives has some measure of risk. And in this video, we're gonna look at two different real world examples of how to employ this strategy. I value you guys so much, I never wanna waste your time, and I wanna always deliver massive value with every video that I make. So without any further delay, let's dive in. The specific income strategy we are talking about in this video is running the wheel strategy, which I'll explain in a second, not on just individual dividend stocks, but on an index. Okay, let's go ahead and define the wheel strategy very simply. The wheel strategy involves utilizing both covered calls and cash secured puts. Step one in this process is to utilize cash in your portfolio to sell a put option on an index or a stock that you would like to own, or at least you would be comfortable owning. By selling that put option, you collect option premium. Now, eventually here, step two, you would be eventually assigned 100 shares of whatever stock or index you were writing the put option on. Step three here is once you actually own the 100 shares, you can then sell a covered call option on top of those shares and collect additional option premium. And then step four here, eventually you will get assigned on that option and those 100 shares will be called away from you, and then you start over with step one with the cash secured put. Okay, let's go ahead and apply this wheel strategy to a real life index. First off, let's go ahead and go into Fidelity here and let's take a look at QQQ. This is the most popular and by far the most liquid ETF that covers the NASDAQ 100. So you come in here and let's go to the option chain right now. Here's the option chain for Invesco QQQ. Let's go ahead and change the expiration to 7 days out. Here are all of our contract expirations we can look at. Here are all the call options. Here are all the put options. This is the strike price right here. And then on each side, there is the bid and the ask. So in this scenario right here, you can see that right now it's trading for $407.73. So it's up today, $3.74 per share. So we come down here, 407 is our strike price. That's the at the money option. So again, we would be starting with a cash secured put in this strategy. Right now, if you wanted to sell a put option, you could collect between 275 and 280 here. Now remember, these prices you have to multiply by 100. So in this case right here, we wanted to sell this put option, we would collect somewhere between, let's just say it's 275 just to keep it simple. 275 times 100 means you collect $275. Now, we need to figure out the yield on this. We would say 275 divided by the amount of money that you have to put up. You would need to be able to put up here quite a sum of money because this would be for 100 shares of QQQ, which would cost you 100 times 407. So that's $40,700. That's a lot of money. So you would take this premium you collect, 275, divided by 4,700, which would give you a really small number. But remember, you are collecting this premium in only 7 days. So we need to annualize this. We need to multiply this number here by 52 weeks. So the yield you're actually collecting is 35%. Now let's reset here. Let's say you get assigned, okay? Let's say you get assigned at, the strike price was 407. So from there, this is still at the money. I'm not gonna change all the numbers here. So let's just assume right here, this is the at the money at 405. And if you want to, you can sell an at the money call option. Again, remember, we're just assuming that this number actually is 405 now because we can't foresee what the option premium would look like in 7 days. So right here, you'd collect an additional, let's just use the bid price here, $290. So you'd collect an additional $290. You'd take $290 and you would divide it by how much money you have set aside. $290 divided by 40,700. You gotta annualize it and multiply by 52, means that your yield is 37%. Now after 7 days, if the price of QQQ does not go above the strike price, you keep your 100 shares of QQQ, you keep all of that option premium, you sell another call option. And you can keep doing this in perpetuity. You keep selling call options as long as you own the the underlying holdings, right? That makes it a covered call. And if for some reason they get called away from you, you continue to sell cash secured puts. So we were collecting anywhere from 250, 270, we'll just say 250 every week. So you take that 250, multiply by 52, divided by 12. That is on a monthly basis, you're collecting $1,083 every single month, and you're only putting up $40,000 in collateral. Let's talk about risk here. What are the downsides to this strategy? First downside here, significant amount of cash required. The reality is with QQQ, you have to have enough cash to secure 100 shares of QQQ, which means that right now, that means in excess of $40,000 you have to have available in the portfolio to run this strategy. In a moment here, we're going to talk about an alternative strategy, very similar but different, that requires half the amount of capital. Second big risk here with the wheel strategy is you could find yourself in a situation where the market goes down really quickly, and the difference between the market price and your cost basis is such that it can make it very difficult for you to actually sell covered call options that generate enough yield. Third risk here, especially if you're doing it on an index, is if you get assigned the 100 shares of the index and it's not one that actually generates a bunch of dividend yield, such as the NASDAQ 100, you could find yourself in a situation where if you don't have enough option premium coming in from the covered calls, you're stuck with this investment that you didn't really want to have in your portfolio long term. So how can we modify this strategy to do it with a lot less capital? Enter the iShares Russell 2000 ETF. Now the great thing about the Russell 2000 is it has still quite a bit of volatility, just like the NASDAQ 100. You'll notice here that the iShares Russell 2000 ETF, ticker symbol IWM, only has a market price of $233.33. If you take that number times 100, it means you only need $23,000 versus the $40,000 you needed to run this on QQQ. So let's go ahead and take a look at the option chain here for IWM. Current price here as of today, right now here, November 22nd, is $235 a share, which means that you would need approximately $23,500 to run the wheel strategy on this index ETF. We're going to look at contracts that are 7 days out. So in this situation, at the money is $235 for the strike price. We would start with a cash secured put. So we're looking at put options here. Here's our bid and our ask. So the question then becomes, what premium do we need to capture in order to get the yield that we are looking for based on these 7-day options? How can we create an equation that identifies what yield we want to receive annualized and figure out what option premium we would need to receive every single week in order to make that happen? Okay, let's see if we can build out the math equation to understand how we can back into the right option premium we need to generate on a weekly basis to get 40% annualized yields. Let's define a few things in the equation. First off, our standard yield equation is the option premium divided by the amount of capital needed. So we'll say that is X divided by $23,500 if we're defining it for IWM. X is that number we don't know yet. That's the option premium. Normally the equation would read X divided by 23,500 equals 0.40, which is the annualized 40% yield. But we have one extra step here. That X here is a weekly option premium, so we need to annualize it. So we would say X divided by 23,500 multiplied by 52 weeks in a year equals 0.40. We can quickly rewrite this as 52x divided by 23,500 equals 0.40. We can then get x by itself in 2 steps here, multiplying both sides by 23,500, which then leads to 52x equals 9,400. Then we divide both sides by 52, which finally gets us x by itself. X equals $180. That means that we need to collect $180 every single week in order to achieve an annualized 40% yield. In this situation, we can see that if we look at the cash secured puts here, we can capture 180 right here at 234. Now, if we're uncomfortable with that, we could go out further to, let's say, 9 days down here to the December 1st contract, or we can accept slightly less yield. Instead of that, we could go to 165 here, $165 instead of 180. Means we won't get 40% yields, but maybe we get 30 to 35% yield on the amount of money we're setting aside, the $23,500. So if we're gonna get assigned, let's say we get assigned right at the money, which would be a best case scenario if we're getting assigned. So let's say we own it at the money now, and it's at 233, but for the sake of ease here, let's just say this is the new contract, 7 days out, and the at the money is 233. We come over here to the call options. And look here, we can collect at the money. If we wanted to sell an at the money option, let's say we don't want to own IWM long term, right? Because it doesn't have a significant dividend yield either. Let's say we want to get rid of it as fast as possible and go back to selling cash secured puts. We can sell it at the money call option, which right now would net you $227.50. 227.50 divided by 23,300 multiplied by 52, which means we'd be collecting 50% annualized yields here on the call option. This strategy, again, is not for everybody. There are clear inherent risks here, which we talked about. Anytime we're talking about selling put options, you could have a significant loss here if the markets really tank. But the truth is, do we really expect the NASDAQ 100 or the Russell 2000 to go to zero? No. And if they do go to zero, we've got much bigger problems on our hands. You could find yourself in a situation where the market's really tanked while you had a put option out there, and you have a significant unrealized loss that prevents you from selling call options. If that bothers you, then what you can do is you can sell further out of the money options. You can sell it for shorter contract durations, maybe 3 days, 5 days instead of 7 days, or you can just go to a dividend ETF or individual dividend stocks that you would be comfortable owning in your portfolio. In the very next video, you guys, I'm going to share with you exactly how I'm going to be implementing this in a portion. It's not all, I'm not going all in on this strategy, guys. I believe in diversification of different income cash flows. I'm going to share with you exactly how I'm opening up a portion of my portfolio to run the wheel strategy on a mix of either index ETFs as well as individual dividend stocks that I would be okay owning in my portfolio. Make sure to leave your 2 cents down in the comments below, guys, what you thought about this video. I know that options are not for everybody. I realize that. If you want to, though, if you're a cash flow investor and you want to be able to replace QYLD, you don't want to pay that expense ratio, you want to capture even better yields than you would get with QYLD, well, then this is certainly a viable option for you if you're okay with some of the risks. Again, everything we do when it comes to investing involves risk. That's all I got for you in this video. Have a great rest of your day, and please continue to stay healthy, both physically and financially. Have a good one.